Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Paul Jackson from Residential Capital Partners. They are one of the few lenders that offers 100% financing for rehab projects on a national scale. They've been in business for over 16 years and have funded a few thousand loans for real estate investors. In this interview, we cover Paul's take on market trends that he's seeing in 2025. We talked about their lending activity over the past few years. We got into real detail about their loan program and some of the requirements. We talked about their company history, and we also got Paul's take on some different markets within Texas. Even though they lend nationally, Texas is where most of their loans are. I hope you find this episode to be insightful. Let's get started. Here's my interview with Paul Jackson. All right, Paul, thanks for joining me for this episode of Private Lending Insights. How is everything with you? How's everything at ResCap?
All is well. We're just blocking and tackling here, trying to get deals done every day.
Great. And tell us about what are some of the trends that you're seeing in private lending and in your business as of this year?
You know, the last 3 years have been pretty steady. It's been a little bit more flat than up and to the right, I would say, with a lot of the housing stock kind of being, I guess, weighted by the interest rates and movements into senior living with the COVID and just lack of transactions as people are staying in their houses long until these interest rates come back down. But we're seeing good volumes. We're seeing a trend towards ground up construction. I think a lot of the RTL and DSCR lenders or single family rental investors that are out there might be sitting on lots that maybe they've been thinking about developing, and with the transaction volume kind of maybe not being as high as it has been in the past, they're going ahead and building ground up construction. So we're seeing a lot of that in this market right now.
And is construction something that you're considering getting into?
We have been doing ground up construction in Texas for the past 6 years. And we're starting to push that out into other markets around the country, just given the demand that we're seeing from our account executive team and the borrowers around the country that we do business with on the RTL front as well as the DSCR front. They continue to ask for that product, and so we're pushing that into other states other than just a great state of Texas.
Interesting. And what are you hearing from your real estate investor clients as far as some of the challenges that they've experienced in the past 6 to 12 months?
I think the challenges they're mainly facing is the older housing stock that they're able to get their hands on. If somebody's jumping from a $250,000 house to a $350,000 house, maybe there's low to moderate repairs that are being done on the house because it's relatively new. But the deals we're looking at right now, if our single family investors can get their hands on them, they might be a little bit older or a little bit more worn. So the, repair budgets to total cost of the deal, might be creeping up and taking them a little bit longer. We've seen average duration on our loans tick from 5.5 to 6.5 months, in a 9 to 12 month loan. So that's definitely a trend we've been seeing.
And how about defaults and foreclosures? Is that something that you've seen in your business?
Well, there's always defaults and foreclosures if you're doing an F business, but historically, less than 1% of our loans have been in default and foreclosure. We saw some accumulation of defaults and foreclosure in some of the judicial foreclosure states around the country, kind of backup that was associated with COVID and judicial foreclosure judges not being in the courthouse to move foreclosed product out. But in general, no, we're seeing kind of historical norms on that front.
That's great. And do you have any predictions as to how things will play out with the residential real estate market with house flipping and construction over the next 12 months?
And my crystal ball is as good as yours. It feels like the 25 basis point rate cut that everybody says the Fed's going to do has already been baked into the market with the 10-year, but we've seen pricing on our DSCR, get better because of that. Hopefully, there's 2026 comes with some more rate cuts that would maybe unlock some of these inventory opportunities that are currently kind of stagnant.
Okay, great. And so as long as the rate cuts continue, then there'll be more opportunities for real estate investors to buy homes and flip homes. Um, and but obviously the interest rates are not really affecting the RTL loans. Your fix and flip loan rates are most likely going to stay the same, right?
Yeah, they're not affecting the pricing that we are offering to our borrowers, but I think our borrowers in the real estate investment community is having a harder time getting folks to consider selling until they figure out where they're going to land. But in general, big picture, the baby boomer population selling into the millennial and Gen Z population, I think that's a 10-year crop. We're still very uh, optimistic on the runway we've got left in this space and the efficiencies that grow over time serving this community.
Let's switch to talking about your business. Let's start with some high level stats from the last 2 or 3 years. If you could just give us a general sense of the loan volume for this year compared to last year and maybe going back to 2023.
23, 24, and 25 were the first years in 16 years in this business that we didn't have double digit or 1.5 times balance sheet growth. We did about 200 million a year the last 3 years. So it's been flat, which I'll take, given you had COVID hangover, interest rates moving up, a lot of questions in the market. You had the war in Israel, you had other things going on in the broader economy. So uh, we've been flat for the last 3 years, right around $200 million a year. Um, and so we're hoping that we can take that up to, 250 and 300 million in 2026 and beyond.
Nice. And you're one of the few lenders that I know that does 100% financing for fix and flip deals, and you're able to do it in most states around the country. And we'll get back to your lending guidelines in a bit, but if you could tell us about some of the states that you like lending in and which states around the country you're excited about lending in for the foreseeable future.
I would say the business friendly states are our most favorite states to lend in, but we're active in the Northeast, the Midwest, the Southeast, Southwest, and the West Coast. We've not done as much in the Northwest, um, but business friendly states, we are still loaning money in judicial foreclosure states. We might be sharpen our pencil a little bit on underwriting. We might do a 90% advance in those states instead of 100% advance, but open for business and feel comfortable there. We've got a lot of relationships with repeat borrowers across the country. So even if it is in a judicial foreclosure state, we're still transacting. We're just being careful.
And according to the data I have from our friends at Fort Casa, it seems like over the course of the last 4 years, you've had about 20% of your loans in Texas, a good amount in New Jersey, Florida, Illinois was one I was surprised to see with the high volume. Um, are has the states that you lend in changed over the past year or two? For example, Florida having challenges with insurance and any of those factors.
I think it's definitely been challenging for our customers, for our clients, for our borrowers in some of those states like Florida with the pricing pressure they've got on the insurance front. Um, we most of the customers we deal with in those states we've been doing business with for a long time. So we know their business, they know our product, and we haven't had any situations. I would say we do monitor that, with hurricane season and with floods. We're very active of getting ahead of that to know where our inventory is. How's our collateral doing? What did it sustain any damage? Knock on wood, we've been lucky to date on that front. We did have a couple of issues in Florida that got resolved with insurance. Praise the Lord, but we're still active in those states. But like I say, in states where the risk might be a little bit higher, we're a little bit more cautious on our advance rate. and more careful on our underwriting.
And how about Illinois? If you could touch on that, that's a state that's not as desirable for a lot of lenders, but it seems like you've done a lot of loans in that state. Obviously, Chicago is the major market there. Any thoughts on that market? Is that something you're still interested in lending into?
We're still doing deals in Chicago. Probably a lot of that has to do with the fact that we got into this business through a partnership with Homevestors back in 2009. Homevestors is a franchise real estate investment firm based in Dallas, and they had a lot of franchisees in Chicago, and so we have deep relationships there with borrowers that we've been doing business with for 16 years. So that's what kind of gives us the comfort level for continuing to lend in those maybe more risky cities or more risky states. And by virtue of those relationships, we're able to extend credit to new relationships in those states just by kind of doing our homework and checking in with some of the borrowers that we have in those cities. Chicago. We're looking at this deal. What do you think about this market? What do you think about this neighborhood? And so that helps us kind of take underwriting to the local level. All politics is local, all real estate is local. Being able to check in with historically strong borrower relationships to vet deals keeps us active in those markets, saying yes where we can and saying no when we should say no.
And when I remember when we were first getting you listed on Private Lender Link, we had to mention which states you don't lend in, and I was surprised to see Pennsylvania on that list. But it seems like you've done a lot of loans there in the past few years. What's your take on Pennsylvania and why the change?
You might have caught my underwriter on a Thursday when we were looking at bad deals, but that's one of those judicial foreclosure states where we had a little bit of backlog, but we're still doing business there with existing relationships. I think we were maybe a little more conservative when we were coming on board with Private Lender Link. We could probably remove that restriction and look at the deals on a case by case basis.
Okay, will do. Any other states or parts of the country that you haven't done as much business in, but you'd like to? For example, maybe the Western states, the Pacific Northwest, any regions or states that stand out to you?
No more than the ones that I mentioned previously. We've been working really hard with some of our banking partners to expand our covenants or our limitations on a state by state basis or on a loan size basis. So we've expanded those to where we can do some larger deals that we historically have not been able to do. We've been capped at 1.5 million. Now we've got access to go up to 2 million or 3.5 million in some states like California, for example, where you know writing an $800,000 loan on 1,000 square foot house in LA, we've passed on a lot of business that may be a 2 million or a $3 million loan with a 4.5 or $6 million value that we should have written. So we're excited about that.
Nice. All right, why don't we switch gears and talk about your loan program, which is quite unique just because of the high leverage that you offer. So tell us about your loan program at a high level. Just give us an overview.
High level, we loan 100% up to 75% of the after repair value of the house, and that's 100% on purchase and 100% on repairs, up to 75% of the ARV. Again, going back to how we got into business, that's really how Homevestors of America trained us as a inside captive finance arm of their franchise network. And when their company sold in 2016, and we started offering our product to the broader market outside of the Homevestor network, we just stuck to our knitting and continued to offer the same 100% advance on purchase, 100% on repairs. Now, that's typically a low to moderate repair deal where the repairs to total cost are 20 to 25% of the all-in budget. As things get to that 30 or 35%, as the repair budget to cost gets to 30 or 35%, we might financially engineer either a down payment or what we call a repair holdback, where we want to see the borrower get to the other side of a completed house with a sign in the yard for sale. But generally speaking, we're trying to bring borrowers to the closing table with as little out of pocket as they can, so that it helps them in the investment cycle of that house.
And that's typically what most real estate investors look for. Obviously, the pricing could sway them a little bit, but talk about the after repair value a little bit, because that seems to be where it would make or break a deal in terms of how much the borrower has to put down. So if the maximum loan to after repair value is 75%, what does a borrower need to do to get approved for that high of an after repair value?
We scrub the ARV really hard, making sure that the value is there. I mean, on average, we're probably sitting around the 70% mark. Um, but we run our own desktop appraisal. Obviously, we're looking at comps in that neighborhood that are close to the subject property, a half mile away, a mile away. So we've got a couple of different proprietary tools in house that get us comfortable with that level of advance rate. And where we're not comfortable, maybe we're still saying yes, but the borrower's coming with a 10% down payment.
And does everyone just automatically get the 75% ARV in their term sheet? Or
We've got borrowers that bring us deals at 65, then bring us deals at 70. I mean, we don't do cash out refi or cash out, RTL loans. But, if there are certain markets, there are certain customers that, hey, I'm in this deal at 72%. There's still plenty of profit in the deal. And then, as a part of our underwriting, we're also doing a synthetic profit analysis on each deal to try to help come alongside our borrower, not just be a lender, but also look at it through their lens, because we come from a real estate investment background ourselves. Is the juice worth the squeeze on this deal? Chasing a deal that pushes them into a higher leverage kind of, territory that doesn't have a lot of profit, or if you make a mistake, the profit evaporates quickly. That's never a good idea. So we really want to see the borrowers come with kind of a one-to-one outlay of their own capital to the profit that they've got in a deal. So if it starts to get squeezed where it's an 85% or 50% ratio and it's not one-to-one, we're actually talking to the borrowers as a partner and saying, you might want to drop this deal and invest your money in something where there's more calories in it for you as an investor, because time and money is all we have. And if you're going to go jump into a project that's less profitable, you might sacrifice the opportunity on two deals down the road for this deal that you finally got under contract.
are there any factors that would cause you to lower that ARV for a particular investor, like their level of experience or their credit score?
Sure. I mean, experience is kind of paramount in when you're pushing 75%. Even most of our experienced investors are usually wanting to stay at that 70% level just because there's more profit margin in it for them. But, if we give an indicative bid out on a particular deal and, credit becomes a concern, maybe we come with a down payment or, shorten our advance to 65 for that deal. So 5% down payment instead of a 10% down payment. But we're considering all those factors underwriting each and every loan that we do.
Okay. And how about, since we mentioned credit, what is the minimum credit score and how do you guys look at credit when you're qualifying a borrower?
Our minimum credit score is 620. Our average credit score across our portfolio is 700. And we do a soft pull of credit through Equifax. So it's not a tri-merge pull or a hard pull, but we want to know our customer. We want to know their credit rating and how they are paying their bills, because we want them to get to the end and sell and make a profit without having to deal with any situations.
And during the loan term, or is the borrower making monthly payments to you?
Yes.
Great. And how about let's talk about pricing. What's your typical interest rate at this time, and points and other fees?
Right now, our rates are between 9.5 and call it 12, probably on average in that kind of 10 and a quarter, 10 and a half range across the whole portfolio. Um, and our points are usually 2 to 3 points.
And how about if the borrower is getting 100% funded from for the purchase and for the rehab costs, um, what 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 are they bringing to the table? Are they paying any fees up front? Are they paying the points up front?
We've
Tell
got
us a
an
little bit about that.
application fee, a appraisal fee for doing a desktop appraisal, and then any other closing costs from the title company or legal that they have to bring is what they're bringing to the closing table at the title company.
And how about the points? Is that rolled into the loan, or do they pay those up front at the time of closing?
They pay them up front. We have rolled them into the loan if there's room, but usually they're paying them up front. We've got a, we require for borrower to have insurance, hazard insurance on the property during the investment period for the life of the loan. Um, we can provide that for them if they don't have an insurance provider, or where there's room, we've rolled the insurance into the loan as well so that they don't have to come with that out of pocket at the closing.
But so typically they're paying the origination fees at closing, whether it's 2 or 3% plus whatever minimal closing costs are.
That's right.
Okay. And how about getting the project started? Does the borrower have to front the first phase of the rehab project themselves?
Well, we will advance at the title company with the purchase proceeds, and we'll hold back all the repair dollars. So yeah, they're getting started with their own capital. That's why we also check in their liquidity during the underwriting process, and then as they make repairs, they're submitting through our repair draw process, pictures of the work they've done. We're verifying that with TruePics to make sure they've done the work. But TruePics is just a tool we found that to be really valuable for speeding up the repair draw process for our customers. It's geo stamped and geolocated, so we know that they were at the property taking pictures of things that they've done. And then, with the inspection and the pictures and the TruePics, then we advance them the money that they've come out of pocket with on the repairs.
And is there a formula that you have to communicate to the borrower that, hey, if this is your project purchase price and rehab budget, here's the percentage of that amount that you need to have in liquidity. Is there some sort of set percentage for that?
We don't have a set percentage, but we just we kind of have a minimum liquidity of $75,000, and that could vary based upon the number of deals the borrower's doing, how many active they have with us, how many active loans they have with competitors or other banks. So we want to verify that with Forecasa as well. Yeah, contingent liabilities are key to understanding to make sure that the liquidity of the borrower is, where it needs to be in order for them to be successful and for us to get repaid.
So 75,000 minimum liquidity, what does that entail? Can it be more than just having cash in the bank?
Cash is king. So we typically try to keep in it, just, bank statements and verifying that. And then we kind of continue throughout the year if we're doing repeat business with the borrower. If a loan comes in after they've closed one in January and they're asking for another one in April, we may, ask for an updated bank statement.
Do you consider other assets as liquidity, like retirement account or any other type of investment account?
And we'll look at investment accounts. IRAs and retirement accounts are not really as liquid. So we really try to stick to bank statements and Fidelity accounts or Charles Schwab accounts, something that they can access if there's an issue.
Okay. And what about borrower requirements? Besides having a credit score, besides the minimum liquidity requirements, is there anything else you're looking for in terms of your borrowers?
Typically, we want them to have experience in the industry. 2 deals in the last 12 months, 2 deals in the last 18 months, some experience in the industry. We've made exceptions on a very rare basis. If they were, an intern for somebody, or they were a carpenter or a contractor for a flipper for a period of time, or they've got general construction experience, or they're a realtor, or have some real estate background. We've made an exception, but that's typically not the customers that come to our window. Most folks that are coming to ask for a loan with ResCap have got experience and can show that with two HUDs presented through our application process.
Nice. And just to clarify, by two HUDs, you mean that they've completed two successful flips
Yeah, two
in
HUDs.
the recent years?
Yeah.
Okay. Okay. And do you have a time threshold for that? Like, does it have to be within the past year, or do you go back a little
Within the
further?
past 12 to 24 months, sometimes folks can't find a deal for a period of time, or they're doing this on the side. So we try to take all that into consideration.
All right. And so someone has taken a real estate course of some kind, but they've never really been in the industry. Uh, it sounds like that's not like likely going to be an investor that you consider lending to.
Well, that would be the other exception besides trade experience or contracting experiences. Home investors, as I've already mentioned, they've got a lot of newbies that have never done a deal, but they've been trained. So we'll do business with them. We've got some other relationships with other real estate training kind of franchise, companies that if we can get comfortable with the training they've received, and maybe they've got a mentor in that organization that's going to oversee them, then we'll stretch and try to do a deal with somebody that's never done business before.
All right. And how do you feel about, let's say an investor that doesn't have a lot of experience and they team up with another investor, so they've got collective experience within the entity that you're lending to.
We love it.
All right.
We
Nice.
love young talent partnering up with seasoned vets.
Let's talk about the exit strategy. Obviously, most people that rehab properties are flipping them, but since you do DSCR loans, it sounds like you're okay with the long-term hold exit strategy for
Yeah,
for a long-term rental.
absolutely. Yeah, we do that all the time, every day. You know, I think a lot of the young newer investors are really keen on getting the profit associated with an RTL deal in their prime. And as they become more seasoned and they look at the opportunity to hold real estate and build wealth with that real estate, they start looking at the DSCR product. Or maybe they want to do a cash out refi to get some liquidity for their real estate business on the acquisition front. So they do a cash out refi on the DSCR desk with us. But there's no better deal than a deal that we have watched be improved and be completed, and the, I guess, risk profile of that asset has been mitigated and gone down over time as the improvements were made, and then they want to turn that into a real property. That's a slam dunk home run DSCR deal.
Absolutely. And then as far as getting new real estate investors, have you had any challenges? I mean, you've got a great program offering the highest leverage possible in the industry, as far as I've seen, and you're doing it on a national basis with a few exceptions. There's a few states you obviously don't lend in, but do you have any challenges with acquiring real estate investors that push back and say, hey, maybe your pricing's too high? Or, I mean, why wouldn't everyone work with ResCap?
I agree. They should all work with ResCap. No, I think we've worked really hard over the last 12 months to close not only on new banking facilities, but also bringing on new capital partners to try to make ourselves more competitive with some of the larger players that have got lower cost of capital. So we feel like um, this year we've consummated a couple of relationships on the capital side of the house that are going to help us, compete better on price, which lowers the payments for the borrowers, increases the profit in the deal, and hopefully will let us attract more business.
And just to clarify the property types, as far as I know, you only deal with residential investment properties, right? 1 to 4 units, and you're not doing multifamily or mixed use or other property types, right?
Single family 1 to 4, and then we will look at the kind of the smaller multifamily 5 to 15, 5 to 20 unit deals.
Interesting. Is that a new offering, the
Yeah,
multifamily?
that's been a part of the work we've been doing this year to have the capital be able to consider doing those deals in addition to, as I mentioned earlier, the ground up construction loans across the country.
And with your ground up construction that you've done so far in Texas, is that also a high leverage program?
It's a I mean, it's 100% of the vertical cost. We don't take out the land cost or the horizontal cost of a ground up construction deal. So most of our builders on that front have made an investment in land. They've completed any work that needs to be done to go vertical. So we'll do 100% of the vertical cost within our parameters.
Great. And is that only for an individual project, or are you doing this with the larger subdivision with multiple homes?
We've done individual projects. We've done, 30 unit kind of build to rent projects. Most of the borrowers we've worked with on deals like that are building in, you know, 5 to 10 at a time, getting them stabilized, taking us out, and then doing another 5 or 10 afterwards.
And the ground up construction lending rollout, is that ready to go in other states, or is there a particular date that you have targeted where that's going to be offered
We're,
nationally?
we're ready to go.
Nice. All right. With that, let's take a quick break and we'll be right back. Support for the show comes from Ross Diversified Insurance Services. All real estate investors and all private mortgage lenders need insurance. More specifically, they need the right insurance partner. For over 35 years, Ross Diversified has been the trusted partner for over 3,000 property investors and 500 lenders throughout the United States. If you're a real estate investor, Ross Diversified can help you whether you're managing a single rental property or a large portfolio of rentals. And if you're a lender, Ross Diversified can protect you with forced place insurance for when a borrower's policy lapses, or with REO insurance in the case of a foreclosure. They offer competitive rates and hassle-free claims assistance. Licensed in all 50 states, Ross Diversified understands the unique challenges of real estate investing and provides customized solutions to safeguard your assets. Visit their website, rossdiv.com, to learn more and request a quote. That's ROSSDIV.com. Please mention that you heard about them from LenderLink and the Private Lending Insights podcast. And we're back with Paul Jackson from Residential Capital Partners. The first time I heard about your company, I was attending a Jurassic conference in Dallas. It was the first time they'd done an event there, and there was a booth there that had your company name on it, and it said 100% financing nationwide. And I remember I was just intrigued because at the time and even till today, there's hardly any companies that offer that on a national basis. So I remember meeting the gentleman that was there manning the booth, and then we chatted, and then he invited me over to your office in Uptown. So I came by, and that's the first time we met, was back in May 2018, and I was just fascinated. But I still to this day don't really know the history of your company in the space and how this is even possible for you to offer 100% financing. So if you could just start with telling us about the journey of ResCap, and then maybe we'll get into the capital side of the business later on.
Sure. No, we actually started Residential Capital Partners in the bottom of the global financial crisis in 2008, 2009. We were formerly commercial real estate investors. We'd worked with Staubach Capital Partners. The Staubach Company in 2006 had sold to Jones Lang LaSalle. So it was really a couple of partners looking at opportunistic commercial real estate deals. I like to say that every commercial real estate investor became a debt buyer during the global financial crisis because banks were closed for business, trying to figure out what was going on, and no real opportunities were trading at that time. So we started looking at debt, um, and through looking at mortgage paper, which a lot of people were buying because the big banks were selling it all off as they were taking in TARP money. We ran into the group I mentioned earlier, Home Investors of America here in Dallas. One of my friends from college actually was a franchisee in Arizona. Um, we did, I guess, formed a joint venture with home investors to underwrite the mortgage paper because mortgage paper at that time was being distributed to buyers and there was no opportunity to pick Texas, or some state that you had experience in. So you had to look at it on a nationwide basis. So we needed somebody with nationwide ability to be able to underwrite the mortgage paper. And so we did a lot of mortgage paper during that time. And as we, I guess, got to know the home investor brand and their franchisee base across the country, uh, we said, hey, in addition to buying mortgage paper, maybe we should also loan money to your franchisees during this period of time because they were struggling to find financing for the investments they were making in single family real estate. So we formed I guess, joint venture with them to provide capital to their franchisee base in 2009. And as a part of that, we actually went to their uh, office and went through 10 years of history that they had loaning money to their franchisees. They were loaning money for a decade before we showed up. Their bank blew up during the global financial crisis, so we became the bank. And so through underwriting the way that they loaned money to their franchisee network is how we came up with the product that we have been actively putting on the street now for 16 years. And so I guess we were really kind of a captive finance arm for them through 2016 until the company sold. The founder of that company passed away. They sold the company to a private equity firm. The private equity firm was not interested in the lending side of the business. So we kind of went from being a captive finance partner of home investors to, for lack of a better word, like a bulge bracket private lender to the single family real estate space. And so that meant sales, marketing, applications, underwriting, closing, servicing. So with that effort, after about a year of really getting our hands around all the aspects of private lending from soup to nuts, we said we might as well go out to the broader market. So that was around 2016 when we kind of stepped onto the stage doing business with the real estate community that was not associated with home investors. And so that model has continued to work with the single family real estate investment community. And we're going to keep trying to grow it and continue to serve the community.
Amazing. And with the home investors network, is it now just an option for them to use ResCap or?
We still have a lot of business that we do with home investors. They've got other lenders that are serving their franchise network, just like every other borrower in America today. That's been one of the most fascinating things about this journey has been, seeing the void of credit that was um, in the market in 2009, and then watching the economy heal, watching the larger capital players start to kind of dabble in this RTL, DSCR space in 2012, 13, 14 to where we are today, where you show up at a conference, you talk to borrowers, and they've got options with every Wall Street brand in the world. So um, the capital coming into this space is, you know, going to continue to grow. There's probably more capital chasing deals today than there was deals chasing capital when we got into it. But hopefully our brand and our presence in the space and the relationships we have with borrowers around the country will continue to allow us to grow and stay active in this industry.
And tell us about the capital side of your business. How are you capitalized? Do you deal with a bunch of banks? Do you have a fund? Tell us more.
We have from the beginning we had relationships with banks and relationships with our capital base, which was primarily family offices, friends and family, high net worth individuals. Um, that worked for us for a long time, for 16 years. But um, we this year we locked arms with a group based here in Dallas called D2 Asset Management. They have a lot of experience in the industry. We were introduced through mutual friends, a lot in common just from the way that we're aligned as partners and the way that we look at the space and the opportunity and the desire to continue to serve the RTL and DSCR investors. So D2 Asset Management and ResCap formally joined in August of this year. And so we're going to continue to try to do what we've been doing the last 16 years, but with capital partners that have a lot more uh, breadth of experience and depth of experience in this industry. They were looking for an originator. We were looking for a capital partner. And so it was a good marriage. And we're excited about the prospects for the future.
Congrats on that. And is this firm one that you were selling loans to?
We weren't selling loans; they were buying loans, but they were looking at the world as a loan buyer and saying to themselves, really the best opportunity to create value from across the spectrum, both for the borrowers and for the investors that are putting money into this kind of product, would be to partner up with an originator and deploy money through the originator. So going direct to borrower, growing our retail presence. And so they were buying loans, but now we're all investing in loans together. And that's our structure going forward.
Hmm, interesting. We've seen this with other companies in our space, but typically they're acquired by a hedge fund or some other institutional lending firm that's acquiring a bunch of loans from different lenders, and they just want a steady flow of business. But with the end goal to be securitizing these loans, do you think that your loans that you originate will eventually end up in securitizations?
I'm not sure. We've always been a balance sheet lender. We've never sold a loan in 16 years. Uh, our capital partner at D2 is got a lot of assets under management and is patient capital, I would say. If it made sense to do a securitization, we could consider that. If it makes sense to hold it on our balance sheet, we've got enough dry powder to be able to do that.
As far as capital goes, and just kind of the health of the market, do are you do you are you not affected by whatever happens within, let's say, the securitization market? Some of the challenges other lenders have seen over the years, in terms of whatever market forces there have been. Are you typically unaffected by those?
Yeah, that was a big deal. That's probably why it took us a little bit longer to find the right capital partner because I think everybody's chasing that opportunity to recognize maybe the efficiencies of the cost of capital associated with a securitization. We had never ever sold a loan in 16 years in this business, which was a calling card for us to the borrowers because we were in control of the capital. We made the decision. We could loan 100% of purchase and 100% of repairs up to 70 or 75% of the ARV value. We came up with it during a global financial crisis. We rode through COVID and kept our doors open when a lot of the Wall Street names that were in this space closed their doors for 6 to 9 months while they waited for the storm to pass. We stayed active in the business. So we were not looking for any capital partner to join our 16 years with. We were looking for the right capital partner, and D2 Asset Management gave us that partner because, uh, yeah, they look at the world the same way we do. We love this industry, we love this asset class. We're fine holding in our balance sheet for the duration and growing it. If for some reason it made sense to do a securitization, we'll consider that as smart finance guys, but that's not a requirement. That's not an end goal. The end goal is to serve the customers, to lower the cost for them, and to help them do more deals as we continue to grow our capital base.
And tell us a little bit about your operation, the number of people, the different offices you have around the country, and anything else you could mention about that.
Yeah, we've got 15 people here in Dallas, Texas, walking into the ResCap doors every day. We've got another maybe I'd say 5 or 6 folks that are what we call lending affiliates, essentially account executives that are out of the office around the country. And then we've got a dedicated capital markets team with D2 Asset Management that's made up of 6 or 8 capital markets executives that have been in the space for a long time, understand it, and will be helping us try to tailor our solutions for the SFR investors to make it more attractive to them to come to the window and create a better partnership, which is why, we picked our name. We want to be the partner to the investor. We don't want to just be a lender. We want to help them grow their business as we grow our business.
And in the rare case where you may have to foreclose on a property, take back a property, do you have an infrastructure or an investment arm of your company that would handle that, or do you just have your partnerships with home investor franchisees that you would potentially sell the properties to?
Sure, we've looked at selling out of assets that either went non-performing or we had to foreclose on REO property. Usually the markets are pretty efficient, and we've been able to move product like that just through the natural course of share of sale or deed in lieu, taking it back, selling it to the market, hiring a realtor. For properties where maybe the repairs weren't fully complete, we have used our relationships with borrowers around the country to say, hey, pick up this deal. It's still a good deal. The borrower had a situation. We had to take it back. Let's go either make them a loan to finish the project, or let's partner somehow, some way, and get this project completed and sold so that somebody can move into it or buy it and rent it.
Love it. All right, why don't we switch gears now and talk a little bit about Texas, because that's your home state. That's where you're based, and it's nice to get insights from local lenders. And Texas is obviously like a country in itself, but I still say that you're a local lender there, and obviously most of your loans are in Texas. So if you could just give us your thoughts on Texas as far as private lending and real estate investment activity. Here in 2025, what markets are hot, and what are your general thoughts about Texas in general?
Golly, I'm going to be a Texas homer on this one. I think every market in Texas is hot right now. Maybe Austin is experiencing a little bit of a correction because Austin historically has gone up and down. But North Texas, out my window behind me, Goldman Sachs is moving their global headquarters here to uptown in Dallas. Morgan Stanley's coming in and building a 200 or 300,000 square foot office. There's all sorts of corporate relocations happening in North Texas and Frisco. Um, we're seeing just unparalleled growth in the Dallas Fort Worth, North Texas market. We're seeing a lot of growth in uh, South Texas as well. We're doing deals in San Antonio. We're doing deals in Austin, even though it's maybe a little bit trickier given the fluctuations in the market that experience. And then we love Houston. So um, the major metropolitan areas and the major growth areas in Texas, we're leaning into hard because, we know the markets, and we know I guess the growth that's occurring in all those cities, not just organic, but relocations, corporate relocations from the West Coast and the East Coast.
And let's focus on DFW for a minute. What parts of the DFW market are growing the most? Does it seem like the most of the growth is towards Fort Worth, or is it north of Prosper, or is it even going out a bit east or south, I guess?
I would say most of the growth in North Texas and the Dallas Fort Worth area is north, Frisco, Prosper, Salina. Though those are the markets where you're seeing a lot of activity from new construction. But, you know, getting back to the basics on what we do, um, usually in most metropolitan areas, there's a loop around a city that, has homes where folks are living and driving into the city to work. So the housing stock of baby boomers selling into the millennials and Gen Z pop is usually somewhere close to that outer loop or the new outer loop, if you will. When you get into Prospers and Salina of North Texas, you're usually talking about, new developments of housing developments that Hillwood or D.R. Horton or one of the big national lenders is building. So the product we see is usually kind of a little bit closer in or in the mid cities in Arlington or North Texas. And we do have some Fort Worth deals and Weatherford deals that are west of Weatherford's just west of Fort Worth. And in the East Texas, not or East Texas relative to the Metroplex, you're seeing Forney, you're seeing Terrell. Um, there's still some growth that way. We've got a lot of employees actually that live in Forney. So, um, like I said, it's a vibrant market here in Dallas, Fort Worth, and in North Texas.
And it seems like there's not as much growth in south of Dallas. Is there a particular reason why that area hasn't really experienced as much growth as the north?
I think it's always just been a more difficult housing market than everything that's kind of west, east, and north. But I would say that as you maybe jump over South Dallas, looking at Waxahachie down to Waco, uh, what what my dad told me when I graduated from college 25, 30 years ago was the golden triangle of, Dallas, San Antonio, Houston, with Austin kind of in between there is going to be one metropolitan area in 25 years. I didn't believe him when I graduated from college, but now I look up and it actually really has kind of come to fruition and is going to continue to grow. So, we've even seen, franchise development from home investors growing in Waxahachie and Waco and markets where they can't get in because the game's locked. But all up and down 35 and 45, these pockets of cities such as the Woodlands, is now it's maxed out. So what are you seeing? You're seeing Conroe become one of the fastest growing cities in Texas. And that's just an outgrowth of the Woodlands. The Woodlands was an outgrowth of Houston, and Conroe is now an outgrowth of um, the Woodlands. And even the Howard Hughes Corporation bought, I don't know how many acres, 5, 6, 7 years ago, because they believe that the growth beyond Conroe is going to continue to move up 45.
And it seems like similar to DFW, Houston just has an unlimited growth. Like you said, it continues to grow north. Obviously, they have the Gulf on the south part of Houston, but it just seems like it never ends. It just keeps growing outward, whether it's west or north. And Dallas a little different because you have the opportunity to grow on all sides. But Houston is are there any challenges that you see in that market? Typically people think about floods.
Yeah, that's definitely, a risk in Houston. Going back 5 or 6 years ago to the big flood that they had down there. But um, I think they've done a lot of work in Houston with, their infrastructure to be able to try to prevent that from happening going forward. But um, Houston's a great market. It's a really strong market, really vibrant market. A lot of industry down there. So I think that's going to continue to be a market that folks are attracted to. I think it's maybe even, moved up the ranks and surpassed Dallas, even though it's an ongoing debate.
Let's move on west to San Antonio. Any thoughts about that market?
We like San Antonio. We've done a lot of business in San Antonio. We've done a lot of business south of San Antonio in the Rio Grande Valley. So um, it's a strong market and it's growing as well.
And the next one close to that is Austin. Obviously, that's a unique market within Texas. Are you a bit more cautious lending there? Are you optimistic about the growth of Austin?
Long term, yeah, I'm optimistic about the growth of Austin. I lived there in 1997 to 2000, so I experienced the Dell boom. They called them Dellionaires that were buying houses up and inflating the prices, and then that forced my wife and I to, chase a house and pay up for it. And we didn't get hurt. We made money on the deal, but the swings in Austin, you hear about them. I experienced them as a young married man, fresh out of college, working for J.P. Morgan. So Yeah, it's experienced a lot of growth, a lot of folks moving in from California and Seattle. They've built a lot of high rise, apartments and condos in the downtown area. Um, the the real estate on the single family side has blown 2x 3x its value from over the past 10 years, but it's a market that corrects a lot faster than other cities. It accelerates faster and it corrects faster than most every city in the state of Texas.
Okay. And let's switch to a different market. There's, you have this part of South Texas that's has had a lot of growth. That's the Rio Grande Valley, McAllen, and the surrounding cities. Do you lend in that region, and is that an area that you're excited about?
Yeah, we loan in the Rio Grande Valley, and we're excited about the prospects in that region. It's another growing market. They've got a new university system with UT Rio Grande Valley. They branded it UTRGV. They got a new hospital, a new nursing school, a new medical school. They've got hardworking folks in that area. It's a great market. We like it a lot.
Nice. And well, there's a couple more. How about El Paso? Is that an area that you lend in?
We have not historically done a lot of business in El Paso. Not to say that we wouldn't, but it's just not been a market that we've done a lot of business in historically.
Okay. And how about West Texas? It seems like real estate investors in that region struggle with finding lenders to do business with, and that's your oil country, like the cities like Lubbock and Odessa. Is that an area that you lend in?
Yeah, Lubbock, Midland, Odessa, Abilene. We've done deals in those markets. We're not really set up to do rural homes, just because the marketability of those homes can sometimes stretch given the population. But in cities where the MSA is 100,000 or more, we can get comfortable with the basics of the ecosystem or the economics of the city, like Lubbock, like Midland, like Abilene. We're active in those markets if the deal makes sense.
All right, Paul, that's all I had on my list for today. Was there anything else you wanted to talk about? Anything I might have missed?
No, man, I just congrats on your new office. That's a great looking office.
Thank you. Appreciate it. And congrats on your merger with D2, and hopefully that helps you expand the business and improves your cost of capital and all the other benefits that come along with it.
Thank you. We're excited. We're excited to get to market and grow this balance sheet.
Great. All right, Paul, thanks for joining me. Thanks for your time, and hope to see you at a conference soon.
All right, man. I'll see you soon. I'll see you at the end of the month.
Yes, that's right. See you in Scottsdale and PLA.
Right.
And that's a wrap for this episode of Private Lending Insights. Residential Capital Partners is listed on privatelenderlink.com. I put a link to their profile in the description. You could do a search on privatelenderlink.com to find them. They're listed in most of the residential categories. You can call them, you could submit a short email form or a detailed loan request form. When you reach out, please mention that you found them on LenderLink. They pay us a monthly fee to be listed, so there's no cost to you to reach out to them through our platform. I hope you found this episode to be insightful. Thank you for tuning in and listening all the way to the end.